They missed on EPS. Okay, that sucks. Heads I win, tails I don't lose much.
It's not possible for a company this size.
The efficient market theory does not work. Meta has had an insane increase this year. The other day they announced they went up 25, 30%, something crazy like that. But the ironic part was they missed on EPS.
Big time, not just small.
Yeah, they missed big time. But what was the real news? The $40 billion stock buyback? Was that what it was?
It was that, and there was some type of antitrust lawsuit that they ended up winning. So everybody was very happy about that.
Okay, so guys, evidence even more what we say over and over again. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. What does that mean? It means in the short run, it's going to go up and down, left and right, like crazy based on popularity, what people's perception is. But over the long run, what's going to matter is the fundamentals of the business. It's a weighing machine. What does the business create and how much do you pay for it? Look at this. In the last 1 year, Meta stock overall is down 17%. It hit a low of $88 per share. According to our software here, $88 per share on November 4th, 2022. I got lucky, and I got pure luck. I bought on October 28th and November 4th itself. But look at this. $88, and it's currently at what? 187.
187, yeah.
Okay, guys, that's insane. And look at the previous high right here. February 7th, right around here, 238. So guys, look at these fluctuations. Are you telling me really that Meta here versus Meta here is over a double difference in company? Guys, it's been 3 months.
Yeah, it's not possible.
How can the company, for those of you who believe in efficient market theory.
It's not possible for a company this size.
It's not possible for a company. By the way, it's not even possible for a company like even our size to triple in value.
It's true.
No, it's not going to happen. This is proof that the efficient market theory does not work. The efficient market theory is where people sit there and say, hey, all stock is the correct price because it factors in all information at any given time. No, it's been proven time and time again that stocks are going to be a voting machine in the short run. People's emotional responses to stocks matter, absolutely matter. You look at a company like that, you look at all these companies, how do they really fluctuate these masses? We've seen companies go up and down 10 to 20% in after hours to opening to the next day. The stock market in general has had 5-6% swings in one day.
Yep.
You're telling me the entire U.S. stock market value changes 5 or 6% in one day?
Yep.
No.
It's not possible.
So if you're the kind of person who's looking for answers like I was back in the day, and I've gotten better and better at it, and I'm still looking for answers, you need to subscribe to the channel. We talk about these things all the time. And if you like hearing me talk more about my musings, follow me on Twitter because I'm very active on there in terms of talking about investing, unlike Instagram. So here are the things we like about Meta from a high level. 5-year return on invested capital, 16.3%. Well, that's a really high number.
Very high.
Now the 1 year is 11.9. Now what does this mean? This return on capital, the higher it is, the less money they need to reinvest back in the business to grow the company. So you want to find companies that take less and less money to grow. That's a very important factor. Now, you also want to find companies that are selling relatively cheap. The 5-year PE is 18.8. The 1-year PE is 21. But why is that, Mo? Why is the 1-year PE higher?
Price spike.
What was that?
Price spike that we've had.
Well, that's one thing. But the other thing is earnings have been a lot lower. Why have earnings been lower?
That's true.
Meta.
Yeah.
They're investing in the Meta. I think last year they said they spent $13.7 billion.
The return on invested capital is so low too. They're not getting a return on that.
Correct. So if you look at the financial statements here, the revenue is down a smidge over the last 12 months versus the previous 12 months. And let's look at profit. Look at this. 40 billion down to 23 billion. Yeah, they're going to take a big hit to Meta. I think I read they spent $13.2 billion on Meta.
Yeah, I thought it was 13.4, but either way,
whatever the number is,
it's a lot.
$13 billion.
But they can afford to do that.
They can afford to do that.
And if they give up on it, that money comes right back.
If they're wrong and Meta doesn't work,
big whoop.
Add 13 billion to this number.
Exactly.
If they're right and Meta works, add
13 billion to that number.
13 billion plus to that number. It's going to be a much higher number.
Exactly.
That's why I look at it going, it's the old Monish Pabrai, if I'm right, what is it? Heads I win, tails I don't lose much.
Yep.
That's the way I look at this company. Now, let's check out the 8 pillars here.
Their gross profit margin is 78.35%.
What does that mean, Mo? What's gross profit margin of 78% mean? First off, that's higher than Microsoft.
It is.
That's almost, that's higher than Palantir, or very close to it.
Let me check.
It means gross margin means, guys, for every dollar of revenue they bring in, 78 cents of it can go to pay overhead, which is usually fixed for a long period of time, and their income taxes. So if they increase their revenue tomorrow by 10 billion, their profit will likely increase by 7.8 billion if they don't have to add more overhead to make that number happen. And they're cutting costs right now. Mark Zuckerberg has said, we grew too quickly. I thought the growth would continue, and we grew way too fast, and we're cutting jobs. Okay, that sucks, but it seems to be what's going on in tech right now.
Yeah, definitely.
Now, they announced that $40 billion buyback. I'm not saying that's a good thing to do, because remember, buying back stock is great if they're buying back cheap shares. So the first thing you have to figure out is, are these shares cheap in price? Because at $88, it was pretty obvious. At $188, got to ask some questions here, right? So what are analysts saying about oh, by the way, look at this debt number, Mo, 1.4. And that's with decreased free cash flow. Guys, they can pay off all their long-term liabilities using 1.4 years of their last 5 years of free cash flow. The company is debt-free. That's incredible. Analyst estimates.
And they just had the most user growth ever on their platform.
Yeah, one in every 4 people in the world use them daily, use one of their apps daily.
It really amazes me that this is the company that everybody was so down on. They said it's a dead company, and now it's the greatest company since sliced bread. 3 months later, Jim Cramer was on television crying, saying, apologizing to people, saying, I can't believe I led you down this road to Meta, and now he's the biggest cheerleader of it.
I want everybody to remember, though, the time you find the best value is when the story out there is very, very bad. Exactly. You're not going to find a good price stock when the story is very good.
Like right now.
I mean, the story is, this is awesome, it's 40 billion. You've got to wait. And you've got to pull your emotion out of it. And that's the hard part. But that's why we have the community here. This is why we do that. We sit here and talk about this because it's important to understand that the only time to get good value is when the masses all believe something that isn't true. The hardest part about investing is not the numbers. The hardest part is to keep that noise out and say, wait a second. I know everybody says Facebook is dead, but is it really dead? That's the question. You got to look at the data. So let's look at analyst estimates. And remember, I don't take analyst estimates as my be all and end all. Just a way of seeing where these guys look at it. We provide it in our software. They're expected to make $8 per share in profit this year, earnings per share. It's supposed to go to $13 in the next 4 or 5 years. Whatever. No idea that's true or not. Revenue, $124 billion for this dead company to $176. So an increase of, 40%, something like that?
It's pretty solid.
All right. Now, the question we asked before is, what's the price to pay for Meta? This is our stock analyzer tool. It was used 1.3 million times last year by our users. But before we get into that, if the software is interesting to you and you want to get this great software that'll make you a better investor and gives you the community of thousands of people to talk to, check this out. I created the software that you're seeing on the video and behind me because I needed software for myself. This is not something that was created for other people and I use some super exclusive, expensive software. This is the software I use. And even better, we have this community of thousands of people there. And the reason it's so helpful is it allows us to eliminate the emotional fear that makes people make the bad decision in investing. The right investing is 20% about the numbers and 80 or 90% about your temperament and emotion. And that's why it's awesome to have this community. The tools help you on the numbers. The community helps you on how to view your investments and your money. So stop making those terrible decisions that all your idiot friends make when they follow companies just because they like the company. For a little over $1 a day, you can have this entire software package. It'll change your entire future of investing and your money. So sign up now, risk-free, everythingmoney.com. Check it out. All right, so now, what price to pay for Meta? Mo, you're going to do the 10-year analysis? I'm going to do 20.
10. Okay.
Now, the reason I'm going to do, while Mo does his numbers, I'm doing a 20-year analysis because Meta is I'm trying to find companies that I buy that I want to own forever. And our software lets us go to 20 years. That's a pretty long-term approach. Plus, it allows for me to even out the ups and downs of the markets, of economy. So 20-year analysis, 4% revenue growth, 7 and 10. I'm assuming they kill it with, because 10% revenue growth over 20 years is doubling 3 times, which is 8 times more revenue. That would take them $1 trillion in revenue, I believe. Let me make sure I'm right on that one. So calculate 1.1 to the 20th power times 118 billion, 120 billion. Takes you to $800 billion in revenue. Okay, profit margin. I'm going to go, it's down recently, but I'm okay with that. Let's go 23, 27, 31. Free cash flow margin, 23, 27, 31. I'll keep it the same. PE, okay. And then desired return. All right, Mo, why don't you go through yours real quick?
Okay, so for revenue growth, I did 6, 9, and 12.
Okay, I did 4, 7, and 10. I think 6, 9, and 12 is good for a 10-year.
Yeah, and 12 is, let's say they kill it in the metaverse and it works out great.
Yep.
20, 26, and 32. And
see, again, I think you should ignore this profit margin of 20. Remember,
okay.
this is based on them investing in Meta.
In Meta. Okay, you're right.
Right?
Let me...
So I think that's a... Let me ignore that for now.
Let me go 24, 28, 32. How about that?
Sure, whatever you want.
Because I want 32 on the high side. Because
I agree.
If they kill it in the metaverse, then...
Well, the reason I went low, I still went low because they still have to lose money along the way on this Meta.
That's true.
I did 23, 27, 31.
Okay, so 24, 28, 32. Same for free cash flow margin.
So did I.
PE, 15, 17, 19.
I did 15, 16, 17 because I'm also on a 20-year.
Okay, 15, 17, 19 price to free cash flow.
Yep.
And I did an 11, 12, and 13% return.
I did 10, 12, and 14. And this is what I want everybody to see.
I actually like the 10. I almost went with 10.
Because 10, even though it's what the market gives, and you sit there and say, well, Paul, are you okay with the market? I beat it up all the way over here.
And I should probably check, because 6%, I mean, they're going to do 6% over 10 years, I think. I would be shocked if they didn't do 6% revenue growth over 10 years.
Maybe.
So... I
tell you what, 4% over 20 years. So that's why I'm okay doing 10% here. But as my assumptions get higher and higher, I need a bigger margin of safety. Mm-hmm. And I look at this saying, okay, 10, 12, 14. In fact, I can make the argument of 10, 12 and a half, 15. Because I look at this high side of 10%. Oh boy. You know what I mean? All right. So what numbers did you get, Mo?
All right, let's see. So I got 182 on the low end, 378 on the high end, and middle ground of 266.
Look at mine. 167 on the low end, 271 on the high end, 215 in the middle. So I look at this saying, even on my lowest and lowest assumptions, 167, we're almost there. And that's why I have my stock on the watch list at 160 because I want to start selling puts at lower prices.
If I put 10% return across the board, it's 196 to 475, middle ground 308.
So that's your intrinsic value for the company at those assumptions. Mine is, ready? 167, 288, and 500. Wow. So if God came down right now and said, Paul, these high-end numbers are going to happen, I should be willing to pay $500 per share for the stock today. I would still get a 10% return over the next 20 years, paying $500 for the stock today. So guys, sign up for the software. Thanks very much for your time. Watch our videos.